What if I told you that political gridlock in Washington isn't just a headache for lawmakers? It could actually be costing you money. Today, we're digging into how government shutdowns and political polarization might be shaking up corporate investment, and yes, even your stock portfolio. Stick around because by the end of this video, you'll understand why political bickering isn't just background noise. It's a real force in the financial markets. Let's get right to it. For years, headlines about government shutdowns or tense budget talks have seemed like more of a political drama than an economic threat. But lately, investors are starting to pay closer attention, and for good reason. The idea that a government shutdown is just politics is getting a lot harder to defend when you look at the numbers. When Washington gets stuck in gridlock, the government can't pass budgets on time. That means federal agencies shut down, workers get furloughed, and essential services slow to a crawl. You might think, hey, that's just a few weeks of inconvenience. But for companies, especially those that work directly with the government, this uncertainty can put billions of dollars of contracts in limbo. Even companies that don't do business with the government can get spooked, delaying investments and hiring decisions just in case things get worse. Let's put this into perspective. During the 2018-2019 government shutdown, the U.S. economy lost an estimated $11 billion, according to the Congressional Budget Office. That's not pocket change. And while some of that loss eventually bounced back, a big chunk was simply gone for good. Now, you might be wondering, how does this actually touch the stock market? When uncertainty spikes, markets tend to get jittery. Investors hate not knowing what's next. If a shutdown drags on, it signals deeper dysfunction in Washington, making businesses and investors alike think twice before making big moves. Stock prices can dip, volatility goes up, and consumer confidence can take a hit. Here's another angle to consider. Political gridlock doesn't just cause shutdowns. It also slows down important decisions on things like infrastructure spending, tax policy, or emergency relief. Policies that have real measurable impacts on corporate profits and economic growth. When these decisions get stuck in Congress, companies sit on the sidelines. Investment slows down. Growth stalls. Some analysts argue that gridlock can sometimes be a good thing, keeping government spending in check. But when it comes to shutdowns, the costs almost always outweigh any potential benefits. The longer the standoff, the bigger the hit to both Main Street and Wall Street. And this isn't just theoretical. In the past, even just the threat of a shutdown has made markets wobble. For example, in 2013, the S&P 500 dropped nearly 5% in the weeks leading up to a shutdown and only stabilized when a deal was finally reached. Investors are starting to realize that the risks are real and they're watching Washington more closely than ever. So what might the future look like? If polarization continues and shutdowns become more common, we could see long-term impacts on how companies invest, how confident consumers feel, and how well the markets perform. But if lawmakers can find ways to work together, even just a little, the markets might breathe a sigh of relief. If you found this breakdown helpful, don't forget to hit like, drop a comment with your thoughts, and subscribe for more insights. Remember, what happens in Washington doesn't stay in Washington. It can hit your wallet, your investments, and the broader economy. So stay informed, stay curious, and keep an eye on those headlines.